Hello everyone, my name is Yunus Erduran and I'm a social entrepreneur and an investor. Throughout my professional journey, I had the opportunity to build a for-profit company focusing on management consultancy, a social enterprise dedicated to educational technologies, and an NGO centered around alternative media and citizen journalism. In creating these organizations, I work closely with researchers, scientists, startup founders, investors, and NGOs, like different parties. What we have been discussing all the time is a common challenge. Our current systems have pushed planetary boundaries to the brink, leaving the capitalist model in a need of reform. To address this, we must adopt a holistic approach, one that balances priorities for both people and the planet. For us, as investors, impact investing opens a path to not only grow up our capital, but also to shape a more sustainable future. Today, I'll offer an overview of impact investing and its key principles. As we all know, investors have different motivations. Some focus only on financial returns, while others aim to address societal issues alongside profit. Traditionally, these goals were separated, with philanthropy addressing social issues. But as our problems grow in scale and complexity, there is a growing interest in using investments to make a real direct impact. This led to the rise of impact investment in late 2000. Which has grown significantly afterwards. According to Global Impact Investing Network, impact investing has now reached $1.6 trillion, funding solutions to our shared challenges like climate change, poverty, and inequality. If you look at the definition, impact investing aims to create positive, measurable social and environmental outcomes with financial returns. This approach targets organizations with a clear intention to address key issues. Impact investors often focus on specific areas such as environment, agriculture, education, or healthcare. Typically, they develop a theory of change framework to guide their investments. Expectations for financial returns are either market average or sometimes below, depending on the asset type. Social impact of investments are aligned with the United Nations Sustainable Development Goals, and organizations are expected to have clear methods for measuring impact. This means impact investors need to put more effort compared to traditional investors, balancing impact with financial KPIs. I have to mention here that impact investing is distinct from ESG investing, or socially responsible investing, and sustainable investing. Each approach has unique goals. For example, ESG investing prioritizes financial returns while incorporating ESG factors for better risk management. Socially responsible investing, on the other hand, focuses on choosing companies that align with ethical considerations. So all these concepts help us to understand how investors define and prioritize impact, how they approach to screen their investments, and how they measure their impact and financial returns of their portfolios. Impact investing spans multiple regions, sectors, and investor types, and it continues to grow. Most impact investments today come from institutional asset owners, like private equity firms, foundations, pension funds, insurance companies, and banks. Family offices and wealth funds are also increasingly incorporating impact-driven investments as part of their investment strategies. Due to long-term nature of impact investments, private equity is a dominant asset class. Private equity investments are often concentrated in developed countries, supporting SDGs like affordable clean energy transition, climate action, industry innovation, and infrastructure investments. Meanwhile, in developing and underdeveloped regions, impact investments frequently focus on poverty reduction and housing solutions through private debt instruments. Besides private equity and private debt, other instruments such as public debt, real assets, and impact bonds are also used according to objectives of investments. I want to give you two examples of impact investing funds that illustrate this concept very well. First of them is Leapfrog Investments, a global private equity firm dedicated to impact investing, and a second one is a Swiss private equity company called Blue Orchard. Founded 20 years ago, Leapfrog Investments was built on the idea of combining profit with purpose. Leapfrog connects over 100 institutions worldwide, directing their funds towards enterprises in emerging markets, particularly in Asia and Africa. Their goal is to help consumers to access financial, insurance, and healthcare products, especially through mobile solutions, for people living with daily incomes below $10. Beyond just providing capital, Leapfrog supports startups by assisting founders with business plans and governance, ensuring their models are aligned with solving real problems. Impact reports show that their portfolio companies achieve solid returns with average annual revenue growth of 23%, reaching over 500 million people in 37 countries. Our second example is Blue Orchard. Similar to Leapfrog, they aim to drive social impact. They have created innovative investment tools like microfinance loans and social impact bonds. Their microfinance fund has supported over 1 million micro, small and medium-sized enterprises across 53 countries. The borrowers are mainly female owners living in rural areas who want to make their living sustainable in their own lands. Through these loans, they have helped creating 4 million jobs in underserved regions. When I started our social enterprise 15 years ago in Turkey, I was often asked why I didn't form an NGO if I wanted to help others, or how I would sustain the business if my primary focus was not only profit maximizing, but impact creation. My answer has always been simple. If you are creating real value and solving a real problem, you will always make money and it will bring profit at the end. Since social entrepreneurs deal with serious problems, not the created ones or hypothetical problems, our challenge is just to find the right solution to solve the problems. And when that solution is supported by a solid business model, the results are always productive financially and even more profitable than others. My personal experience is also supported with the findings of Global Impact Investing Network report, released in 2024. There, 86% of impact investors say that their financial returns were outperforming or performing in line with their expectations. And 90% says the same for their impact returns. For me, this proves that we can channel our capital in a way that positively transforms both planet and people. On that note, I would like to leave you with a couple of recommendations. First of all, we all know that current issues are complex, and even with impact investing, solutions are not easy. Just keep in mind that impact investments are long-term investments, and you should adjust your expectations accordingly while managing your portfolios. Before investing, I suggest you to think about your own theory of change framework. What you want to change as investor is one of the most critical questions to decide on which domain and which areas you will invest. That investment will make you proud at the end of the day from the perspective of personal fulfillment, and it's very important to focus on your own values and link it to your investments. And lastly, impact investing thrives on collaboration rather than competition. It's important to engage constructively with founders, asking thoughtful questions to understand their challenges. This not only builds trust, but also opens space for you to integrate your skills and insights into building a resilient business plan together. Thank you for listening me. I hope this video encouraged you to consider impact investing as one of powerful options to turn our capital into real change for collective welfare.